All right, guten Morgen. It is just after, I guess it's 6:33 in the morning. That's about 3 hours before the cash open on Wall Street. Welcome to QuantBox Live, where we get your global macroeconomics on, but also in particular today, I want to cover fundamental analysis of the United States of America for a sense of global risk on. So we have an important week. So I'm going to go through, I'll go through QuantBox a little bit, but I want to highlight the fundamentals of the week, kind of set the stage, if you will, talk about what's important. But anyways, hey, QuantBox, what we do is we use AI for data and analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, both institutional and retail positioning, and seasonality and market sentiment. Yeah, not just long-term sentiment, but what's actually happening today. All right, so there's two different types of sentiment. Anyways, I'll show you. It's awesome. My name is Wayne McDonald. I'm the founder of QuantBox.co. I have a bachelor's degree in macroeconomics and a master's degree in financial management, both from Harvard. I also studied, what did I do? Alternative investing at Harvard Business School. I have a certificate there. I have a certificate in cryptocurrency trading from MIT and algorithmic trading. I have a certificate there from Oxford University. Their algorithmic trading program is awesome, by the way. So, anyways, I know a little bit. I've done a little thing, and and I've been trading for over 20 years. Neato. So, anyway, I love QuantBox because I'm trying to figure out what the long-term trends are. I'm trying to figure out why money's moving, not just the fact it's moving and I'm chasing candles, but I'm anticipating the trends before they happen, and therefore I can participate in the trends. So, anyways, we have lots of pretty colors that help us analyze the markets. This is what QuantBox is. This is what you should be doing. Now, you can take a trial for less than $8. That means if you're watching this on YouTube, you're watching it many hours delayed. So I'm glad that you have the information, but why don't you join our community? In fact, if you take the annual membership, what I do is I unlock like a lot of other tools, a lot. You get a lot more power when you use the professional subscription. A lot more tools, an amazing amount more tools. But if you add it up, it's actually cheaper. Well, I've already committed to it since I'm paying for everything. So I kind of want you to commit to and use the tool. So, anyways, welcome to QuantBox. Let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Let me just quickly go over the QB just to get a sense of where we are. What I'll do is the dashboard, the gauges, and the heat map. And then I want to go over and do fundamental analysis off the box, if you will. Sometimes you got to think outside the box. All right. So, anyways, oil, really? Oil's down to 80? Really? Hang on. Let me double. Oops. Didn't want to do that. Hang on. Is it really? I haven't looked at it a little bit. Is it really an 80? Or let me double check this. Thought it was a little higher. I guess maybe it's coming down. Brent oh, there it is. Yeah, it's $80 on the nose. All right. So yeah, that is right. Let me bring the QB back. All right, that is correct. That is the right price. It was a little higher. I was long at like 79 on Friday, got knocked out on a flash crash, if you will. It seemed like a flash crash to me. But anyways, a big drop, and then it reversed and went all the way back right to where it was. But so now it's just sitting on 80. Okay. The yield on the 10 year is still very, very, very high. 2 years going to be very high. I think what we're pushing 5 now. Wowzer. Okay, euro dollar. Hey, it was stuck at 110 recently, and now it's at 108. Bitcoin going nowhere fast. So still sort of mediocrity at best as far as today's concerned. Looking a little further out, we went from risk off to neutral. So this just recently, like on Friday, was risk off, risk off, risk off. And then even last night on Sunday, when the markets were opening, it was risk off, mixed. Now it's risk off, mixed, mixed. And I'm anticipating a change from bearish, bearish, bearish to bullish, bullish, bullish. That's what I'm anticipating. I'm not necessarily, observing that change yet, but I'm anticipating it, and I'm trying to trade. I'm trying to trade that. Okay. So, anyways, I think I'll skip the heat map because nothing's happening. I can tell by the day, the daily bias is, for example, yen futures are flat, 10-year T notes flat, Dixie's flat, gold is flat, S&P 500 is up a little bit, cool, and VIX is up a little bit. So, not a lot going down. Great. So, one of the things I wanted to cover is why I'm anticipating a change in trend from risk off to risk on. Now, we have to step back. I did a quarterly outlook in whenever it was, a couple of months ago. And the idea was July and August was going to be a fade, that the markets were going to come down, but I'm not necessarily long term bearish. It's a fade, not necessarily a reversal. And so things like the stock market would fizzle out, the yens would come down, the dollar would get strong. And by and large, I think that's generally true, depending on the asset you look at. But I look at many of them, and I would say it was generally true. That did happen. Cool. So now the next thing is QuantBox is helping me decide that that fade is generally over soon, and that we're going to go back to the trend. What is the trend? Well, before the fade, it was very much risk on. Remember in June, the market was rallying, May and June, because what? That the recession wasn't likely to happen, and the Fed cycle of raising interest rates were almost over, and that they would be slashing interest rates in 2024. Well, I don't know if I fully believe that narrative, but there's probably some truth to it, maybe. And we're likely to find out this week whether there's going to be a rally. Okay. A year end stock market rally. Isn't that the whole, the kit and caboodle right there? Isn't that what we're trying to figure out? Well, I think we're going to learn a lot of things this week. And so I can look at the calendar, I suppose, quickly. I'm just going from memory, but I guess you should actually use the tools. I'm just going from memory when I was thinking about it this morning. Loading, and then we can change the impact. Oops, wrong one. What's it doing? I'm clicking on all the wrong things. There we go. High only. And so we want to look at jolts this week. This is job openings. It's a soft data point, but what we're observing is less and less jobs being advertised. The Fed's not going to make a big stink about it, but if they wanted to make a point, they would add this as icing on the cake, where they're like, well, look at jolts. So there was a divergence. There were more jobs than there were people looking for jobs. In fact, there was twice as many jobs than people looking for jobs. And so what the Fed wants to see is jolts coming down, and we're kind of in that trend. Although it looks like they're thinking of it popping back up. Oops. Okay. Consumer confidence. Well, that's Europe, 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 Europe. In fact, let me change the currency. I just want to focus on the US right now. US only. Okay. ADP, another employment report. The Fed wants to see this as a positive number, but a lower positive number, because a lot of our inflation is from people have too many jobs, and because so many employers are looking for people to work for them, and there's not enough workers, they'll have to pay them higher wages. Okay, so again, the Fed would like a low number, See, it was 325. Now they're thinking 200. Okay. Continuing claims. Okay. They would probably want a slightly, or initial claims, slightly higher, not out of control, but slightly higher, meaning people are losing their jobs, which would be deflationary for wages. And then PCE, that's a big one. That's way out on Thursday. Um, that's the Fed's measure of inflation. CPI has been down a couple of months, PCE hasn't. So it'd be nice if PCE started coming down. Okay. And then non-farm payrolls, that's on Friday. Once again, we don't want a negative number, but a less higher number. So we were pulling like 300 and 500,000 on these NFPs. Now we're only expecting 150, and we're probably going to look at revisions of past months being revised down. Okay. And if we see all of that, we might see the market believe the Fed is nearly done their process. That there might be one more hike, maybe there won't be. Maybe there won't be one in September. By the way, I told you in January that there wouldn't be a rate hike in September. So fingers crossed. When you make a call, now I'm like, but I don't think they're going to raise. I think they're going to wait one more time. But anyways, all of this we need is this week, and it's answering two questions. I suppose it just answers one question. Inflation, because they're both related to inflation. Um, con- if consumer spending is slowing, then inflation is likely to come down and the Fed would be nearly done. That's a rally. If jobs are like 100, if NFP is 150 instead of 250, okay, once again, the employment market is slowing. Wage growth would probably slow. The Fed would be nearly done. That would make the stock market rally. Personal income. If your income is falling slightly, it's disinflationary. That would be interesting if that was slightly down or flat. But here's the big one, PCE. We want to look at PCE again. If it's less than last month, I think that's going to be the first one that's less than the month before. CPI's got a couple of those, so we want to look at that. Jobless claims going up once again would be stock market rally, because the Fed, what the Fed has done is starting to work, so the Fed doesn't need to do much more because of all the lagging. Jolts and ADP are all the same. So I wanted to give you, I just pulled this up right before our meeting. I wanted you to take a look at the data. So this is the Fed here. I drafted this for you. You take a look. Okay, so here we have PCE. You can see up, 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 up. This is the Fed's measure of inflation, not CPI. So it'd be interesting if it ticked down. That's all. That's it. That's all. Right. In particular, you want to look at the PCED, the personal consumption expenditure deflator. Now we're getting all gobbledygook economic stuff, but you want to see a lower number than before, because that would be disinflationary and that would make the stock market rally. That's on Thursday. Average hourly earnings. So yes, NFP should be a lower number, fine. And we want to look for revisions lower from previous months, fine. But the astute want to look at wages. We want to look at wages. We don't really care about the headline number. We want to see wages moderating or even falling as a sign of all the things the Fed has done is starting to take shape, and that the Fed will actually get to their 2% target. We want to see disinflation, which means the Fed is nearly done. Mission accomplished, stock market rallies. See, all of this gets down to one point. Is the stock market going to rally in September? Yes or no? That's all I care about. Okay. And so I'm boiling down to really just a couple of things. How about retail sales? We want to see this coming down a little bit too, because it shows less spending. So we get Personal income this week, we want to see slightly lower because that shows a decline in the wage growth spiral. Yeah, that's actually a thing. So we want to look at personal income. Is it moderating? We want to look at retail sales. Is it moderating? We want to look at wages. Is it moderating? We want to look at PCE. Is it declining? Okay. Again, on Friday, yeah, headline NFP. Sure, that's what the kids will watch, but we want to look at the wages subcomponent. Okay. Because, yeah, okay, you got a job, great. But if you make 2% less than you used to, well, that matters. And that's what we want to pay attention to. Okay. So there's the week. There's the week. This is an important week. Again, we're going to find out this week whether the stock market is going to rally up. And I'm already trying to engage into that narrative. Okay, right now it's neutral and we've been fizzle fading for a while. Okay, so definitely, technically, it's been negative, but seasonally, it's turning positive. You see the plus one. Let me spend it for you. Okay, so S&P 500 is falling, but get ready for some up. Is what the market is talking about. Okay, get ready for some up. So I'm trying to prepare for that. It may or may not be up now, but we will find based on that fundamental analysis whether the stock market's going to go up. So we can look at the stock market just since we've talked about it. Where's my drawing tool? Okay. So, anyways, we had we had a fade back in June, back in this period. I think it was the third week of June, somewhere in this period. Okay. I prepared us for um made a reasonable, decline in the stock market in the January and August period. Well, it rallied up and then it collapsed. So really nothing's happened. So did I do the right thing hedging in here? I think so. I mean, again, it went up a lot higher than I thought. Well, I didn't know what the future was. I only knew what the potential of risk was. So I managed the risk basically right before this double top. And now we're right back to where we were. So nothing, not hurt at all. But this fade definitely happened. And so now what we're trying to figure out is this going to happen? That's what QuantBox says get ready for. Now, of course, it could do this. So now I have to combine technical analysis, right? I just know that the up might be coming. So how do I thread this together technically? So now I zoom in. This is the projected bottom for the month, by the way, based on this top. So on this day, especially if you already thought it was going to fade, well, it double topped and it dropped. And this would have been your target based on the top. This is just basic technical analysis. And so now I'm waiting for seasonality. So now I have a double bottom. See this one? See that little spike on Friday? Now I have a double bottom. And now with the, sort of quant box analysis in the back of my brain, there's a potential for something like this. So I'm long at the double bottom, as you can see. Here's a long position. Cool. There you go. So that's me trying to tiptoe into the bullish waters, but it's technically bearish. Okay. Danger, danger, danger. But I'm thinking ahead. I'm thinking forward. I'm thinking September. This is a September trade. Now, based on technical analysis, if I were to get the full Monty here, I'm going to call this the price. Okay. So therefore, based on that, that's the target. And you can see that's basically a top, double top. Let me squeeze that in. Basically a double top, right? But QuantBox says if I get that right, I'm probably quite a bit righter than that, and I'll be in for a few months. Yeah, and that's the power of QuantBox to give you the strength and courage based on your rational research to let your winners run. So I might not get out of this trade this year. Cool. Thank you, QuantBox. Gold, same thing, kinda. Let's back out. This is a daily chart on gold, and I've framed this as a bottom. Okay. I'm challenged on this 21. There's a high probability it's going to fall and I get knocked out at break even. Okay, fine. But my argument here is growth falls and inflation rises. So we have, slowing GDP, but persistent inflation. Well, I might be wrong there because we might throughout the week find out PCEs come down and NFPs come down and wages have come down and commodities have come down and the stock market, what, could come down further? That could happen. So I'm long anyways, and I'm willing to take the risk in case my other trades are wrong. One of them is going to be correct. So it's kind of interesting. It's like, it's almost a hedge. It's not really a hedge, but anyways, if inflation is persistent, gold will go up. It's been falling because inflation's been disinflationary. But if we sit around 3% or even go back towards 4%, now it actually needs to be hedged again. Cool. Also, like, what if China wants to stimulate its economy by lowering the value of its currency? How would it do it? It would take money out of its vault, buy gold, put the money into the interbanking system, and put the gold in its vault. So on the balance sheet, it's let's say it's a billion. There's $1 billion less in cash, but $1 billion more in gold. The balance sheet is still balanced. Nothing happened. Except now there's more money in the interbanking system globally, more yuan, $1 billion worth of yuan. So the supply goes up and the value goes down, and now its currency is lower, and that's stimulating its economy. But there's less gold in the world now on the open market. What happened? China bought up $1 billion worth of gold. So now the value of gold goes up because demand went up. And then I'm sitting here going, oh, snap, China's helping me out. That's my play. Is it going to happen? I don't know. It's just a shot. Don't judge. I don't have any risk. So, how dare you judge me? Like, oh, that's the whole point. All right. So, anyway, so that's what's going on. Other things, I'm not ready to trade the dollar yet because the dollar has been strong. I'll just show you. We'll do this. Dollar has been strong, and as you can see, I've already anticipated the, 3 weeks ago. But at some point, maybe soon, it'll roll over and become weak. I don't know if it's going to roll over here or go higher and then roll over, which is a fancy way of, I don't know if it's going to roll over before non-farm payrolls or after non-farm payrolls. But roll over it might. Maybe it'll roll over and become weak after the Fed meeting at the end of September. I don't know. I'm just anticipating it will. But it doesn't look like it now, so I'm going to pass. But what I do want to trade is yen weakness because, well, that looks bearish. Don't you think? So I pass in the dollar because I want dollar weakness, and I go for yen weakness. So I'll pull those trades up. Okay. And I'm tiptoeing in to yet another Aussie trade. Now, Typically, I poo-pooed on the Aussie dollar. But last night there was more talk about Chinese stimulus. The Chinese stock markets were up 1%. So I bought it at support. I don't know, right? It's worth a shot, isn't it? I think so. So we'll see what happens next. I'm on a 5-minute chart for crying out loud. So, it's I'm going to scalp into a spot into a swing. But the classic day trade has already occurred. Okay. We had the classic entry, which is right on the market open. Based on that, okay, this is the target zone. Yeah, yeah. See bullish profit zone, profit take, right? Those are the two prices. So based on this entry, okay, that target's happened. So it's already happened. And now what I'm interested in is a resumption in this direction. Okay. So I don't feel great about it, but it is playing off the China data news. Okay. I'm looking at euro once again, trying to build off of an old top. So here's an old top. Here's an old top. There's an old one behind it that you can't quite see. And then what happened? Okay, we breached to the top. We came back. I bought it right there, and I'm trying to okay, trying to hang on. As you can see, it's not just a buy. What I did was down, up, slingshot. Okay. And I feel a little more comfortable with the euro because the ECB will raise interest rates and they will not cut interest rates in the next 12 months, let's say. So I got that. Uh, 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 my own pound. I wanted to buy that. I might actually have to buy that. But right now I'm coaching. It's an interesting because we're in a reverse. I call this fib wars. Like somebody's going to do that. Oops, but somebody's going to do this. And so, yeah, we have fib wars going on here. You might find that's too many lines, so maybe you draw a Gartley pattern. How do you want to do this one? That okay. I might actually try to buy a dip on this one. I kind of like the dipsy do thing. The reason I've been hesitating on this one is even Aussie dollar had a 4 hour that had a 21 above the 55, and this one doesn't. Um, how about this one? Here's a kitty cat. Let me get rid of this old trade plan. And you'll see inside of this, you have that. Let's do it like this. Okay. So we might be breaching to the upside. Again, I'm front running what I believe is very possible risk on, which means the US stock market would rally. So here's the fade. Okay. We have the down, 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 up, sell, down, 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 up, sell, down, 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 up, up, down, down, buy, up, down, buy, up, down, buy. Is that going to happen? Well, we'll find out. So I'm long right here. And I'll make money if this breach continues and we step up. Okay. Technically, what I'm trying for is something like this today and further up for the rest of the week. Okay. And I would expect at least double top, but I would be planning for 109 to 110 minimum. And then for those that are watching on YouTube, or for those that are new to either QuantBox or to me, I will remind you, because it's important psychologically, that in January, I said on all these assets that I'm long now, I told you in January that the third week of August, I would be looking to buy all these assets I've bought in January. And it's now the fourth week of August. I actually bought these things last week. What is that, 36 weeks in advance? So if it works out, fingers crossed, either I'm a wizard, or you can find this data buried deep in the data, and that there are repeatable patterns, and there's logical reasons for this ebb and flow of money, like being able to predict the tides, or being able to predict the lunar cycle or solar eclipses. I predict on Wednesday in North America, we're going to have a blue moon, and they don't happen very often. They're rare. There's going to be a blue moon, right? Because I'm magic. No. Actually, these are logical cycles that have been seen before, written down, and recognized as patterns. So, yeah, we're going to have a blue moon on Wednesday. And I'm hoping the stock market rallies between now, let's say now and the next 3 weeks. Yeah. And if I'm right, it's not because I'm a genius or a supermodel. It's simply because it's in the data. And so, to the subscribers of QuantBox, you have access to this data for your trade planning. And for those on YouTube, kick down, come clean, don't be a holdout machine. You know you want it. So QuantBox.co. And without further ado, I wish you a wonderful week. This is an important week. So throughout the week, keep asking yourself, does this mean the stock market's going to rally? Does this mean the stock market's going to rally? Does this mean the stock market's going to rally? Or is the narrative switching and we're definitely going into recession? What we're hoping is inflation cools off, but we don't go into recession. Goldilocks. Slow growth, but not negative growth. Okay. So with that, peace on earth. May the pips be with you. May our profits be above average. Cheers.